Good morning. This is Perrin Cornell with Coldwell Banker here in Wenetchee, and this is part three of some programs I put together dealing with real estate information and tips for buyers and sellers and experienced people. Some of it will be on, might be more for first-time buyers. Some of it might be for experienced investors. So there'll be a little bit of information in here. I'm pleased to have with me this morning Kinwin Rudnick. Kinwin is a CPA with Veritas Accounting, right?
Yep, Veritas.
Veritas, thank you.
Yeah.
And you have offices in Okanagan County and in Douglas County, right?
Right.
Okay, good. Full disclosure, known Kinwin for several years. I've been a client of hers and she's been a client of mine, and that's kind of how we came together. But I think a lot of her work. So one of the first things maybe to talk about is people that might be thinking about buying. They probably got some, in fact, I know they do. I was looking at a chart the other day, and even people that were just bought 2 years ago may have as much as 100 grand equity in their house. So they may want to capture that equity. And to capture it, of course, I guess the first step would be selling. But there's some things to remember about how long you hold it for, and then what about the tax consequences of the 100,000 when you sell it? Kinwin?
Absolutely. So that's one of the most crucial parts when you go to sell a home, and it is owned in your personal name. And you want to go ahead and sell, but you don't want to pay taxes. I think that the primary home exclusion is one of the very, very best ways to make money tax-free. I absolutely love it. However, you do have to live in the home for 2 years. So 2 of the last 5 years, you have to have lived in the home. Now, I once had an instance where the person sold the home 1 month shy of the 2-year limitation. And it was because their real estate agent and their lender told them it would be fine, but they were thinking of rules that are old rules where you would defer the gain. That's not the case anymore. You do have to own and live in the home at least 2 of the last 5 years. For a lot of us, that's pretty straightforward. Sometimes it gets a little more complicated if we do leave the primary home, purchase another, and maybe rent our first home like you did with us. But in most cases, it's pretty straightforward. You live there, you own it for 2 of the last 5 years, you get over that 24-month hump, and then your first $250,000 if you're single, or $500,000 in gain, not sale price, in capital gain, is tax-free. So if I build my house, and I built my house, and we were all in for like $400,000, and we sold it for $775,000, and I'm married filing jointly, my gain was completely non-taxable because it was under $500,000.
Okay. Now, can you roll that gain into the next house, or no? It's a single transaction, right?
That gain is yours to do with it whatever you want.
Okay.
They've really made it a lot easier for homeowners to capitalize on their equity in their homes. So Brandon and I could very well have bought an RV and tootled around the country. We didn't necessarily have to buy this piece of property in order to keep it tax-free. It's not a rollover. It's not a deferral. It's just a flat out exclusion.
Okay, super. Now, if you're a first-time home buyer and you're going out there in the market, and they've been renters, so now they're going to have things like property tax, insurance, home repairs, things of that nature, some of which is deductible, or maybe, and some of which probably isn't. Can you give us just a little insight on some of that stuff?
Absolutely. So the first-time home buyer rules were a lot more favorable prior to the 2008 issues, that we had some mortgage credits and we had a bunch of things that are no longer applicable. However, you do have the ability to dig into your retirement funds, your IRA, and not pay a penalty if you're under 59.5 if you are a first-time home buyer. Is it something I usually recommend people do? No, I don't always like to see them dig into their retirement funds. However, if you're coming close to closing and you've got $10,000 standing between you and the house and you can access it, you can do so by getting into your IRA and not paying a penalty. You will have to pay the taxes on that withdrawal. It's not tax-free distribution, but you won't be penalized like you would if you just took a regular withdrawal and you were under 59.5. The other thing is that a lot of people are very concerned about those deductions when they buy a home, and rightly so. We do always run the calculations in my firm when we prepare a tax return to see if itemizing, meaning not taking the standard deduction, would be beneficial to the client. However, the increased standard deduction for married filing joint is now over $25,000. So it's pretty hard for a lot of people to get over that hump, because they would have to have more than $25,000 in property taxes, real estate taxes, and mortgage interest. And so recently, I've only really been doing Schedule A itemized deductions for single people, because their standard deduction is lower, that do have a rather large house or a rather large mortgage that's going to put them over that 12, 13, 16, depending on their filing status of deductions.
Okay. We're getting a little problem with the transmission. We're getting a little freeze screen. We can hear your voice perfect, but every once in a while you get frozen, but that's okay. Another question that came up just the other day, a fellow was thinking about buying a duplex. He'd never bought one before. And he was going to rent, buy it strictly for investment. And he had heard that the amount of loss that he might realize from the transaction or from the operation of the plex because of interest and all those other expenses in the unit, that he might not be able to deduct everything annually, or is that still the case? It used to be a limitation.
Yeah. There is still a limitation. So we have this really fun saying in accounting. It's called PALs need pigs. Passive activity losses need passive income gains. Oftentimes what happens really,
what was that again?
Passive activity losses, PALs, okay, which are passive activity losses, need pigs. So gotcha. PALs need pigs, which are passive income gains. And so a lot of times, due to the depreciation, which is the way we cost the purchase price of the building itself, land is not depreciable, over 27 and a half if it's residential, or 30 plus years if it's commercial. Due to that, the depreciation and the interest, we often do have a rental loss. It's very common, except in the case of short-term rentals. And if you are an active participant, and there are, some very finicky rules about what that means, but if you're an active participant in the rental, your losses are limited to $25,000 per year. If you are a qualified real estate professional, and there's even more rules around that, but it's basically someone like you, Perrin, then your losses are not limited. And so we do a lot of these tests with people who have quite a variety of holdings. And we do ask, hey, is your spouse willing to become a qualified real estate professional? What are some proactive planning things we can do around these rental property strategies? But yes, losses can be limited. We have a variety of ways of juggling that. Like I said, we've also seen people balance their short and long-term rentals to balance out their gains and losses. And that's worked really well too.
Okay, super. Any other tips you can think of off the top of your head?
Real estate is an incredibly fun and diverse area. We really enjoy working with people in the profession, and the variety of holdings. It's just something where it really pays to, in my opinion, be proactive. There's very little we can do, or anybody in my shoes, CPA, EA, can do when you come after the fact and say, this is what I did last year. And we go, However, if you come beforehand and say, hey, I really like this mobile home park down in Arizona, and I want to get rid of my duplexes or my apartments here, what are my gains going to be? I'm going to go, let's look at a 1031 exchange. Let's see what our options are. So the more proactive you are, if you are looking into investing in real estate, the better your realization of all your different options and savings are going to be.
Good. Yeah, I was going to ask you about the 1031. It kind of slipped my mind because I have a couple clients that do 1031s. Actually, you and I have a client that does 1031s. Yeah. And it's a good tool because you basically just,
and you can't do that retroactively. I have people go, well, I did this and I want a 1031. Yeah. And I was like, do you have a qualified intermediary who held the funds? They're like, well, no. And I'm like, well, it's too late. You can't do that. You have to go into it with a qualified intermediary set up and all the pieces ready to go.
Yeah, basically, you don't get the money; it goes to the intermediary, and then they.
Yeah.
Okay. Well, hey, Ken, thank you very much. Give us a plug. What's your address and your phone number and your email address? And I'll give you there will be a little ad at the end. But tell us a little bit.
So our primary office is at 645 Valley Mall Parkway in East Wenatchee, upstairs in Suite 200. And then you can also reach us at office@Veritas, VERITAS, accountingsolutions.com. I know it's long. Or you can call us at 509-888-0543.
509-888-0543, right?
Indeed. Yep.
Thank you very much. Real estate's hot yesterday. Today, it's not quite as hot. It's only 102 instead of 110 or something, but enjoy going up to Lake Bonaparte. That'll be great today. I bet it'll be crowded up there today. Have a good time.
I hope not too badly. We'll see.
Okay. Have a great time and say hi to your Brandon. Okay. See you later.
Thank you. I will, Perrin. Have a fabulous day. Bye.
You too. Bye-bye.